Ladies and gentlemen.
Good evening.
Are you ready?
Okay, here we go.
You're listening to the Deal Room Podcast. Join us as we bring you the inside scoop on business sales and acquisitions. Get across trends in the area and hear the industry's best recount their real-life tips, traps, and experiences. Now, here's your host, Joanna Oakey.
Hi, it's Joanna Oakey here and welcome back to the Deal Room Podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. Now, today we talk about the importance of understanding your most likely buyer, whether that is corporate or an individual, with a return guest, Roy Levy from Core Business Brokers. Roy is a corporate advisor specialising in business divestments, mergers and acquisitions in the mid-tier market and the SME market across Australia and New Zealand. And in this episode, Roy and I talk about the elements you need to consider when identifying where you think your buyer might be coming from. We drill into the difference between corporate buyers and individual buyers. We look at the most overlooked differences in selling between the two. We also explain the advantages and disadvantages of working with each type of buyer. In this episode, you will hear heaps of tips and tricks in getting to a quick deal and getting the job done efficiently. So here we go with our discussion with Roy. Roy, welcome back to the Deal Room Podcast. I am so excited to have you back on the show.
Thanks for having me. It's a pleasure to be here.
Great, wonderful. Now, today we're talking about what I think is a very interesting and important topic, the importance of understanding your most likely buyer, whether that's a corporate or an individual. Maybe give us a bit of the background here, Roy. Why does it matter? Who cares who the buyer might be when we're thinking about heading out to market?
Jana, it's a very important question when a seller asks you what is your opinion on the sale of the business and you're trying to understand the business. We always ask for the background, and the reason we do that, we need to understand the size of the business, the sales, the trends, very importantly, number of employees, where their markets are, because trying to understand the business, we are always at the back of our mind saying, where is my buyer coming from? Who is the natural buyer for this business? So typically one can say that if a business has a value, a sale value, up to approximately $3 million, maybe even $4 million, typically that would be an individual who is going to buy that business, because the seller of that business would typically be the driver of that business, the decision maker, making all the appropriate decisions and keep that business going well and profitable. And therefore, if it was sold to an individual, you'd expect that individual to step into the shoes of the existing seller, do a handover, and move on. That's not to say that a business of that size cannot be sold to a corporate if it is a strategic, what we call bolt-on acquisition and fit to that corporate player. But generally speaking, you'll find that individuals at that level, up to $3.5 million, it would be an individual that is the purchaser of that business. When it comes to a corporate business, generally speaking, and again, there's always the exception, if one approached a corporate business or a private equity type player, unless the business was making an EBITDA, that's earnings before interest and tax and depreciation, of at least $1 million, generally the answer is, Roy, if it's not doing $1 million, don't waste my time, because they have to apply a lot of management time to assessing that business. And if it's not $1 million plus with a lot of options to increase it, they're generally not interested in buying that business. So that's sort of your first definition of, is the buyer an individual or a corporate? It's really the size of the business, and that dictates where one should market a particular business. And sometimes there is a bit of a crossover when you're getting to the $4 to $5 million size business.
Yeah. And one of the things that I find interesting in this difference between corporate and individual buyer is where the power sits between the two. So when you're selling to a corporate, generally speaking, if the sale is from an individual, a bunch of individuals who've run the business, almost from startup or for a long period of time, usually that's the only business they know. They're not experienced in the process of selling a business. Selling to a corporate, you're selling to someone who is extremely experienced in the acquisition of a business, has advisors who are extremely experienced in the acquisition of a business. And that power differential or disparity can sometimes be a huge problem if we've got a seller who hasn't got access to the right advice, in my opinion. I've seen, some difficult situations caused by parties that have not had the right representation, and perhaps they've worked that out along the way or whatever the case may be. Maybe can I get your opinion, Roy, on what are the most overlooked differences in selling to a corporate buyer rather than an individual? And that might be within the transaction itself or even in the lead up to the transaction in terms of how to make the business attractive to one or the other.
The key aspect of that, first of all, is the role of the current owner and the functions he or she plays in that business. Remembering, if it was an individual who's the buyer, they would be expected to step in and into the shoes of the owner, learn from him or her, and then run the business as the decision maker going forward. In the case of a corporate transaction, generally speaking, unless it was a really strategic bolt-on and there was some individuals there, a corporate player would not expect to come in and sit in the shoes of the current owner. They would expect the organizational structure to be in place, that the business continues pretty seamlessly into the future once the current owner steps out. So that's the one key difference. Who's going to continue to run that business going forward when the owner eventually leaves? And there's often a disparity or a gap in that. So if you're saying to the current owner, if there's someone in there or a general manager that can step up into his position, start training that person up front and be ready for the transition. So again, one can answer that question constructively by saying, we have a competent general manager who can step up and take over my position without missing a beat. So that's one critical aspect. The next critical aspect is the due diligence of a corporate owner. Very often a corporate owner would be happy to purchase the business as a going concern, but the equity, they will purchase the shares in the equity because it makes the transaction a lot cleaner in that no contracts need to be changed, nothing needs to be changed, everything remains the same. However, the due diligence requirements for that from the buyer's perspective is quite significant. And therefore, with that expectations in mind, and of course, by the way, the seller would first have taken the advice from his accountant, what are the capital gains tax implications on the sale of the business, and should the transaction preferably be a share sale or an asset sale. So that will first determine it. And we always encourage our sellers to have that conversation with their accountant together with us so we understand what it is. And if the impact, as we just had last year, was that one set of advice was, in fact, it was that a business that I've mentioned to you in a previous talk, the manufacturing business. The advice was sell it with the shares, and then when we got a share, they had made an error. It was going to cost the seller $500,000 of capital gains tax, and we had to then backtrack and go back to the seller and apologize about the mistake, and then say it now has to be a share sale or asset sale. I can't remember wherever it was. Luckily, we got that across the line. But it's important to determine that early so that the information memorandum specifies exactly the nature of the sale and what it's going to be. But the corporate player, it's important to have all the backup in the data room ready to go for due diligence, which has an audit trail back to the IM. That whatever we're saying will check out in a due diligence, which a corporate player will undertake, and that that could be quite time consuming as well.
Yeah. I just want to pick up on a couple of things that you mentioned. In one of the things you mentioned about the benefit, if you think that your buyer might be a corporate buyer or someone who wants to come in and see a management team continue without them having to come in and run the business themselves as a buyer, you need to think about who you're going to have as, say, for example, a general manager on board and them trained up so that they can stay on with the business. Just want to point to the absolute importance in that instance of recognizing that you've now transferred a bit of that risk to key person risk in that general manager. And so you just need to, it's an excellent strategy, but also then needs to be paired with this. What are you going to do to make sure you retain this general manager that you've brought on board and that they don't run off with what has now been created as a lot of value sitting in that person as well. So that's where we can think about some of these creative elements in terms of, remuneration for those key staff members based on the price you achieve, based on staying in the business for a particular period of time if there's an earn-out, maybe even getting the buyer on board to giving them a bit of, or bringing them into equity as part of the deal, those sorts of things. But super important to have your mind on that before the GM runs rather than after. So that's just my one point on to back up what you're talking about there. The other thing I just thought, maybe we should we talked about the differences mechanically or from a technical perspective when you're looking at a corporate buyer versus an individual buyer and from the preparation. But maybe we haven't talked about the advantages, because I think one of the big advantages out there is as soon as you can open your business up to a sale to a corporate buyer, as well as potentially individuals maybe, you not only do increase the pool of possible buyers for a business, but corporate buyers will most often pay more than an individual buyer as well, particularly if there's a strategic advantage for their business. So I think that's another, and that's quite often why we see, isn't it, our sellers really keen to think about the sale to a corporate buyer because they understand that potential uplift in value.
That is 100% correct, Jana. So typically you'll find, and depending on the size of the business being sold, if it's a larger business with a transaction value or what we call an enterprise value upwards of 10 million plus, then typically your corporate player comes into play. And if that corporate player is, for example, a small cap public company, which would typically be trading on a price earnings ratio of 10 times, then they could afford to pay a higher price and it would still be earnings positive for that public company to pay a higher price. So there's no question that on that basis, if that is your targeted buyer, your price expectation would be higher. The other side of the equation, of course, is that that corporate buyer, independent directors on their board. And the independent directors, of course, before they sign off on a deal of this nature, like to really what we call de-risk. And therefore, one of the requirements is what we call an earn-out. It's not a definite requirement, but it's one of their preferred requirements to say, Mr. Seller, Mrs. Seller, if you're telling me you're going to make $2 million profit last year, we are buying the future. You've had the past. And if we're going to price the business on $2 million earn-out, we need to be pretty certain that is what we're going to earn in the next year or two. So that is where they make one of the conditions an earn-out for that business to de-risk it and make sure the profits are what has been achieved in the past. Many private sellers don't like that. In fact, the majority don't like that because if the new owner runs the business in a different way, then of course the earnings may not be there. What we've done on occasions is say to the buyer coming in, we don't know how you're going to run this business. We're not sure what expenses you're going to load or not load into the business, and we cannot control that. So one way of doing an earn-out is make it on a simple number, such as a sales figure, because that's something that may well be controlled. So if it's going to be an earn-out, try and simplify it with a figure that can be measured a lot easier than a profit, where you've got a whole host of expenses that you cannot control. So that is one way of making it simpler. And the other thing is, of course, if the seller does agree to some kind of earnout, then we would encourage the seller to stay on for the period of the earnout, let's say 12 months, so that they can be there and control and assist to make sure that that number is achieved, and it's not left to someone who may not run the business well to not achieve that, and that will then affect the earnings of the seller. So there's a number of considerations, to play with when you're considering an earnout, if it turns out that way. Of course, the price for an earnout can be even a little bit higher. If the seller is insistent that they will not do an earnout, then the corporate player may still go ahead but drop the price a little bit because of the earnings risk. And that's an option. Sometimes a seller will turn around and say, well, that's fine. I'm happy with that. I'm happy with the price, and let's do it on that basis. So that's the difference between a typical corporate player and versus a private individual buying the business.
And I just want to add into that, I would say, and I alluded to this earlier, so repeating the concept a little bit, but just the absolute importance for sellers to a corporate buyer having someone who can be in your corner, who understands the game, who understands what to look out for, because more often than not, you'll end up with the contract being driven by and drafted by the corporate buyer in that instance. They can be really long contracts. They can be very complex contracts. And it's super important that you have someone in your corner who can pick out where the issues are and what are real issues versus what might be red herrings, because you don't want to be caught in this constant forwards and backwards of endless negotiation. Worse still, death by email negotiation. Constant red lines, forwards and backwards. You have to have someone in your corner who can get in there and argue, reasonable. Say, for example, you've got an earnout. There's a whole heap of controls that we can put in there for earnouts. If you're forced into an EBITDA calculation for the earnout, so an earnout based on profit as opposed to top line revenue. I completely agree with you about it would be so much better if you can control it and make it simpler related to top line revenue. But we all know sometimes, quite often, corporates will come in and require the earnout to be based on profit. But then you need the right clauses in there. You need the controls. You need to make sure the earnout accounts are prepared by stripping out any extra costs that head office may have put in there, or extra expenses they've lumbered on the business, or indeed protect them if there's no commitment to continue marketing the business or doing the sorts of things in the business that are required to enable the business to continue to grow to meet the earnout. So I guess that's just the last thing I wanted to put in there. It's critically important if you're looking at selling to a corporate buyer to understand that you need someone in your corner who understands the area.
Jana, that is absolutely critical. When we sell the business and we start the process of preparing the business for sale, one of the questions we immediately ask: who is your accountant and who is the solicitor that you use? Because if it gets to the sale, you need to have the appropriate consultants and professionals on your side who are able to manage a transaction of this nature. And that is very, very critical. If, for example, and the solicitor of the seller has really been instrumental in doing leases, and that's where their speciality lies, with respect, we will suggest that maybe we should be looking at a corporate solicitor who has a lot of experience in this element of a sale, be it a share transaction or whatever. And our role will be, once we've got a deal in place, and a term sheet, negotiation of a term sheet, and then it goes to due diligence where the accountants get involved, and then contracts of sale. We then become the choir master, making sure that all elements of the deal are controlled, whilst the owner of the business continues running his business. Because what we found is the transaction is, while it can be a term sheet can be signed, it takes time. It takes weeks and sometimes months. And right at the end, before a contract is exchanged, and remember there's no legal deal until it's exchanged, the buyer then comes back and says to him, by the way, how's the sales been going for the last 3 months? And if the owner has taken his eye off the ball during all this work that's been going on and the sales have deteriorated a little bit, that can scupper the whole deal and be back to zero. So I always say to the vendor, now's the time to work even harder than you have before, so that when the question comes, and it will, how's the last 3 months gone? You can show them that it's better than ever. The deal will move forward because they know that they're buying a good business. So it's very critical to have all the elements in place, trustworthy, competent people, so that he can continue to run the business, and what goes on behind the scenes, he can be reliably informed as appropriate to make the decisions, and his advisors are running behind the scenes and getting the job done.
Yeah, and getting the job done efficiently too. You know, one of the things I always say, a quick deal is a good deal. A good deal is a quick deal. And not always the case, but I do find that, one of the greatest frustrations, I think, in this space can be, and, certainly some of the frustrations I have with counterparties in this space sometimes is just the slow approach. That can happen with, parts of the deal team, the legal team, the accountants, whatever the case may be. And I hugely subscribe to the theory that you should not have millions of drafts and redrafts flowing between the parties. You get everyone together quickly to negotiate any issues all together in an all parties meeting. You get through them, you get to an answer, and you get the deal done. And I just think that is so critical as well to that component of the business and the business owner being able to maintain focus on the business and not getting sidetracked by a long, arduous negotiation process.
Absolutely critical, and it can be very taxing on and emotional, because it's often the biggest asset that the owner has now setting off to this years, and when a buyer says something not quite derogatory about the business as part of the negotiating tactics, it affects the owner, and we always say to the owner, we will deal with that. We are the meat in the sandwich. We take the body blows on your behalf. That's our role. Leave that to us, and we'll direct you as to where you need to get involved or not. So it's very critical to do that and keep the emotional stress as low as possible, and let him just concentrate on running the business until the deal is settled, and then they can relax.
Then he can run off in his sunset with their bags of cash. That's right. Or stick around and work through that earn-out, whatever. Roy, look, I just want to say a huge thank you to coming on to the Deal Room podcast. How can our listeners get in contact with you if they're looking to gear up for a sale of their business, or indeed if they're looking to buy a business?
Easiest way, Jada, jump onto our website, www.corebb, so that's corebb.com.au, or send us an email, sales@corebb.com.au. Our contact number is on the website if you prefer an initial chat. And our motto is we will always respond within 24 hours to your communication, be it an email or telephone call. And no obligations to have a free chat to you. It will be our pleasure.
Absolutely love it, Roy. A huge thank you for coming on to the show today.
Thank you for having me. It's been a pleasure once again.
Well, that's it for this episode of the Deal Room podcast with Roy Levy from Core Business Brokers, all about the importance of understanding your most likely buyer. Now, if you'd like more information about this topic, then check out our show notes where you'll be shot straight across to our episode page at the website www.thedealroompodcast.com. There you'll be able to download a transcript of this podcast episode if you'd like to read it in more detail. And of course, there we will also link straight through to Roy Levy and Core Business Brokers if you would like their assistance during the sale of a business or perhaps an acquisition. You'll also find details there of how to contact our legals at Aspect Legal Legal about anything related to buying or selling a business. And you can book yourself in a free 15-minute discussion with our legal team at aspectlegal.com.au. Well, that's it. I hope you enjoyed what you heard today. If you did, don't forget to subscribe to the Deal Room podcast on Apple Podcasts, Spotify, or your favorite podcast player to get notifications straight through to your phone whenever a new episode is out. We also love hearing feedback, so please leave us a review and rating if you're already one of our subscribers or even if you're listening to this podcast for the very first time. Thanks again for listening in. You have been listening to Joanna Oakey and the Deal Room podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. See you next time. I am so very excited to announce that I've hit a non-podcast related milestone and released a book. You might wonder why? Simple. I wanted to help business owners understand the mechanics of deal making and the interaction between three critical phases of business: acquisition, growth, and exit. And so I am very happy to announce Buy, Grow, Exit, a guidebook for business owners and their advisors on how to buy, grow, and guess what? Exit in a way that maximizes value and avoids landmines along the way. The book is available now, so just head over to buygrowexit.com.au to get your copy and to access a whole heap of free resources that will really help you on your journey of acquisition, growth, and exit in your business or in working with your clients. Also, check out our show notes where we will link straight through to that page.
Ladies and gentlemen.
That will conclude this evening's entertainment.
Thanks for listening to the Deal Room podcast. To find out more about this episode and other episodes in the series, check out the show notes or head over to our website at thedealroompodcast.com.au.